8:24 on the phone from Tokyo is Nick Smith, Japan strategist at CLSA. Morning, Nick.
Good morning to you.
So we were talking earlier about these sentiment surveys that are coming from the US and Europe. Seems to be suggesting a global slowdown is well underway, and maybe some of these economies are on the brink of recession. How is all of that going to affect Japan?
Well, you always think of Japan as a geared player on global trade. So if the world's slowing down, it's certainly not good for Japan. The majority of its profits are produced offshore. So ultimately, 60% plus of profits are produced offshore. That said, if you look at consensus forecasts for GDP growth for this year compared to last year, the one that has essentially no slowdown at all, although it started relatively low. But the one that's got no slowdown is Japan. Other places are off 4.5 percentage points. And then when you look forward to next year, they're seeing continued slowdown, and Japan's looking for a little bit of an acceleration. I mean, it certainly helps if China accelerates next year, but I think the point there surely is that everybody else used their fiscal stimulus early. Japan's using it late. Everybody else managed to get out of COVID early. Japan was hit by the Omicron wave late. And is opening up late. So those things together mean that fiscal stimulus is coming through as it's running out of puff elsewhere. Reopening's coming through somewhat later, and that's holding the economy up somewhat. So that, I suppose, is a reason why the topics, at least in local currency terms, is only off less than 3% year to date, whereas the rest of them are getting hammered.
And also, of course, Japan's got ultra-loose monetary policy still as well, hasn't it? One of the few places left in the world now to have that. So can that continue, and will that help as well?
I think there are people that believe that this time is different, and that the widow-maker trade of shorting the Japanese bond market is going to work for them. People say, of course, don't fight the Fed, and they've not got used to don't fight the BOJ, despite having been carried out from trying to do that many times. But of course, the BOJ has been a lot more aggressive on monetary policy than the others. So if you look at the beginning of 2007, the BOJ's assets were 21% of GDP. Now they're 135% of GDP. They certainly don't lack the resolve, and fighting them, I think, is very dangerous. So yes, I think they can continue if they're minded to do so.
Now, of course, what's interesting is the BOJ is keeping interest rates negative, even though inflation has now crawled above the Bank of Japan's 2% target. And Haruhiko Kuroda says that this is just temporary. It seems to mirror, or remind me certainly, of Jerome Powell a year and a half ago, claiming famously that rising inflation was transitory and was proved horribly wrong. Is the Bank of Japan making the same mistake?
To be fair, there are only there are two areas of inflation in Japan: oil, particularly, but also food. I think there's a decent argument that oil comes off. The inflation's actually slowed a little bit over the last couple of months. I think they have understandable concerns about whether that level of inflation will stay in place. What we've got to remember, of course, is that there's a new governor of the Bank of Japan from April next year. And so we look at what's going on at the moment, and it beggars belief that what they're doing is taking vast amounts of government money to subsidize particularly oil, but also food, and paying for that by issuing bonds that they're selling to the BOJ, and the BOJ is buying those bonds in order to create inflation. So you've got to ask, what is it you think you're trying to achieve? Are you concentrating on the brake or the accelerator at the moment?
So if it wanted to, the Bank of Japan has got an exit now from this ultra-easy monetary policy, hasn't it? It was in a bit of a bind before, but it could cite rising sort of headline inflation above its target and use that as an excuse to maybe at least go some way towards normalising its monetary policy.
Yeah, I mean, I think you've got to restrain yourself in talking about what normalisation is. So I think the probability is that there's enough criticism of inflation and even of the governor of the Bank of Japan at the moment, so that the replacement will be not a Ministry of Finance guy who wants to keep down interest rates to keep their interest costs down, but much more a BOJ guy who looked back on the hyperinflation of the early war years and say, we never want to go back there again. But then if you put one of those BOJ guys in place, what will they do? Well, I think that the chances are, at the moment, the 10-year is held at 0 plus or minus 25 basis points. They might open that up to plus or minus 50 basis points, but I don't think they're going to say, you know what, we're just going to let it find a level. I don't think that's in the cards.
And very briefly, then, from an investment perspective, you think Japan can continue to outperform, and where in particular would you look at in Japanese stocks?
Well, I think the fact is Japan's incredibly cheap. It's got the stimulus, the growth is better, and of course, if you look at the real effective exchange rate, it's off 58% since mid-1995. So as a production base, it is brutally competitive. So yeah, I think now is the time to be picking up stocks that are high dividend yielders with defensiveness.
Okay, Nick, thank you very much indeed. That's Nick Smith, Japan strategist at CLSA in Tokyo.